Hey everyone! Welcome back to Ceylon's Smart Finance channel. Today, we're diving into a juicy piece of stock market history, the Nifty 50. These were the hottest stocks in the late 60s and early 70s. Trust me, you don't want to miss this. Alright, picture this, it's the early 1970s, and everyone is raving about the Nifty 50. These 50 stocks were like the rock stars of Wall Street. We're talking McDonald's, Disney, Polaroid, Sony, you name it. These companies were leaders in their fields, attracting massive institutional investment. In 1972, the P/E ratios of the Nifty 50 stocks reached astonishing heights. For instance, Polaroid had a P/E ratio of 90. McDonald's stood at 60. Investors were confident in the growth prospects of these companies and were willing to pay top dollar for their shares. Look at this chart. Sony at 60, International Flavors and Fragrances at 70, Disney at 80, and HP at 45. These numbers are incredible, right? But here's where it gets interesting. The mid-70s brought a storm. The oil crisis, rising inflation, and economic recession hit hard. The market crashed, and those sky-high P/E ratios came tumbling down. By 1980, Polaroid's P/E ratio had dropped to 15, and McDonald's had fallen to 20. So, what caused this collapse? Let's break it down. Economic recession. Multiple recessions in the 70s hurt investor confidence and earnings. Oil crisis. The 1973 to 1974 oil embargo sent energy prices soaring, slowing economic growth. Inflation and interest rates. High inflation and rising interest rates made borrowing expensive and hurt economic activity. Overvaluation. Those crazy high P/E ratios were based on unrealistic growth expectations. Corporate performance. Some companies couldn't keep up with the high growth expectations. Guess what? Even investment legends like Warren Buffett, Peter Lynch, and John Neff were involved with Nifty 50 stocks. But they played it smart. When valuations got too high, they sold. These masters knew the importance of keeping a balanced portfolio and not getting swept up in market hype. The big takeaway here? Even the best companies can be risky if their valuations are too high. It's all about balance. Investing in quality companies for the long term is great, but you have to watch those valuations. Let's talk about the lessons we can learn from the Nifty 50. First, valuation lessons. The Nifty 50 showed us that paying too much for even the best companies can be risky. High P/E ratios can be justified by strong growth prospects, but they also carry the danger of significant losses if those expectations are not met. Second, long-term investment strategy. Despite the volatility, some Nifty 50 companies like McDonald's and Disney continue to perform well over the long term. This validates the idea of holding quality companies for the long haul, provided their fundamentals remain strong. Now, let's look at how these investment masters managed their portfolios. Warren Buffett invested in some Nifty 50 stocks like Disney, recognizing their long-term value. He's known for his disciplined approach to valuation and sold these stocks when they became overvalued relative to their earnings potential. Peter Lynch, managing the Magellan Fund, held positions in several Nifty 50 companies. He emphasized understanding the business and growth potential, adjusting his holdings as market conditions and company fundamentals changed. John Neff, a value investor, was also involved. He invested in Nifty 50 companies but was careful about valuations. He reduced his positions when he believed the market had overestimated growth potential. Now, let's compare this to the 2000s tech bubble. Both periods saw skyrocketing valuations based on high growth expectations, but when the bubble burst, the stocks plummeted. It's a powerful reminder that market conditions and investor sentiment can change rapidly. Here's a comparison chart. Look at the similarities in the P/E ratios and how they spiked before crashing. It's fascinating to see history repeat itself in different ways. The big lesson here is to always be mindful of valuations and market conditions. It's essential to learn from past market bubbles and crashes to make better investment decisions. I hope you enjoyed this trip down memory lane and picked up some valuable investing lessons. If you did, smash that like button, subscribe to my channel, and hit the bell icon so you never miss a video. See you next time on Ceylon Smart Finance.